Hi, it's Edward W. Cotney. This is a chapter review from my first book, Tax Secrets Made Simple. I specialize in working with high net worth families who are ready to pay less tax for the rest of their lives. I wrote this book to help business owners and individuals begin their journey to pay less tax. Let's jump into the next chapter. Chapter 18, Income in Respect of a Decedent, commonly called IRD. This one's a toughie. So we mentioned in Chapter 4, when we talked about creation, accumulation, utilization, and distribution of wealth. This one here has to do with distribution. We've died, we've left some assets to the kids. Some of these things have a tax component that is called income in respect of a decedent. Personally, I think that I named it wrong. There's nothing respectful about leaving a tax bill to somebody. They should have called it income in disrespect to the client, to the decedent. So what is IRD and what constitutes IRD? The easy way to understand income in respect of a decedent is that these are assets that have never been taxed, that have been given to someone else, like when you pass away. IRD, income in respect of a decedent. Normally it's income tax, and the kids just pay it based on how they receive it, when they receive it, added to their ordinary income. Here's where it gets interesting. Let's say that your estate is subject to estate taxes and you have an IRD asset, like a traditional IRA with $1 million in it, or a 401k. Currently, the lifetime unified credit for estate taxes in the year 2023 is $12,920,000 per person. Big one. If we go back to the old tax code when the TCJA tax rules basically end in 2025, it goes down to a low number like $6 or $7 million per person. So it's a huge change in our wealth transfer rules. With that said, if I have $1 million IRA and I'm subject to death taxes using the current rules, that IRA will be taxed death tax, and it will be ordinary federal income tax to the child. And if they live in a state with state taxing issues like California and others, the federal tax alone on IRD starts at 62%. Add California to it, 9 to 13%, depending on the kid's income stream. We're now talking 71 to 74% tax on an IRA 401k. So, if you have large IRAs, and if you have an estate that may become subject to estate taxes, this is one of those assets that we label as hot. This is a hot taxable asset because it is going to be subject to multiple layers of tax. My advice here, if you think you're going to be subject to estate taxes, sit down with your CPA, run an estimated death tax return called IRS Form 706. And if you find that you're going to have a large estate tax and IRD tax component with your assets, it would be wise to take corrective steps now to start converting some of those IRD assets. Even though it's going to be a tax consequence, this chapter is about income in respect of a decedent. It is something to pay attention to. I hope this message from my book, Tax Secrets Made Simple, has inspired you to learn how to pay less tax and enjoy more life. In my videos, I share insights into how to utilize the most generous tax code on the planet, courtesy of the Internal Revenue Service. Please like this video and subscribe to my channel. Visit my website, olympustax.com, to buy my book or contact me. Only you can exercise your right to pay the least amount of tax due. Watch for the next video covering another topic from my book, Tax Secrets Made Simple.